Investing is all about making choices. It's a journey where you decide how to allocate your money with the hope of achieving financial growth. The primary goal is to grow your money over time. But the path to achieving this is filled with various options and strategies. Every investment comes with the potential for both gains and losses. The financial markets are inherently volatile, and prices can fluctuate based on numerous factors. We call the possibility of earning a profit return. This return can be in the form of interest, dividends, or capital gains. However, there's also the chance of losing some or all of your investment, which we call risk. Risk is an inherent part of investing and cannot be entirely eliminated. These two concepts, risk and return, are fundamentally linked. They are like two sides of the same coin, always present in any investment decision. Higher potential returns usually come with higher risks. This means that while you might earn more, you also stand to lose more. Conversely, safer investments typically offer lower returns. These are more stable and less likely to lose value, but they also grow your money more slowly. Think of it like this. Putting money in a savings account is relatively safe, but the interest earned is low. It's a secure way to save, but it won't make you rich. Investing in the stock market has the potential for higher returns, but the value of your investment can fluctuate significantly. This volatility can be both an opportunity and a risk. Understanding this trade-off between risk and return is crucial for making sound investment decisions. By balancing these two elements, you can create a strategy that aligns with your financial goals and risk tolerance. Risk plays a significant role in shaping our investment decisions. It influences which investment opportunities we choose to pursue and how we allocate our resources. Risk-averse investors prefer investments with predictable, stable returns, even if it means accepting lower potential profits. They are comfortable with the certainty of knowing their investment is relatively safe. On the other hand, risk-taking investors are more comfortable with uncertainty and volatility. They are willing to accept higher levels of risk in pursuit of potentially greater rewards. Understanding your own risk tolerance is crucial for choosing investments that align with your financial goals and comfort level. Before diving headfirst into an investment, it's essential to assess potential risks. Two widely used techniques for this are sensitivity analysis and scenario analysis. Sensitivity analysis examines how the outcome of an investment changes when one variable is altered while keeping others constant. For instance, we can analyze how a project's profitability changes with fluctuations in interest rates. Scenario analysis, on the other hand, involves creating different plausible future scenarios, each with a different set of assumptions about key variables. This allows investors to assess the potential impact of various economic conditions on their investment. By understanding the potential impact of different variables, investors can make more informed decisions. Simulation modeling takes risk assessment a step further by using computer programs to generate thousands of possible outcomes based on probability distributions assigned to key variables. This technique creates a range of potential results, each with an associated probability of occurrence. Imagine you want to invest in a new product launch. Simulation modeling can factor in uncertainties like production costs, market demand, and competitor actions to provide a comprehensive picture of potential outcomes. This approach allows investors to assess the likelihood of achieving their desired returns and the potential downside risks. Section 5, Expected Net Present Value Averaging Out the Uncertainties. The Expected Net Present Value, or ENPV, is a valuable tool for evaluating investments with uncertain future cash flows. It calculates the present value of expected future cash flows, taking into account the probability of each cash flow scenario occurring. Think of it as calculating the average outcome of an investment, weighted by the probability of each scenario happening. By incorporating probabilities, ENPV provides a more realistic assessment of an investment's potential profitability than simply looking at a single point estimate. This approach allows investors to compare different investment opportunities with varying risk profiles on a more level playing field. Section 6, Event Trees, Mapping Out Potential Futures. Event trees visually depict a sequence of possible events and their associated probabilities over time. They are a powerful tool in decision analysis, allowing businesses to visualize the different paths that might unfold from a single decision point. By laying out these paths, companies can better understand the potential consequences of their actions. They help investors map out different potential outcomes and make informed decisions based on the likelihood of each event occurring. This method is particularly useful in scenarios where uncertainty is high and multiple factors could influence the final result. By considering various scenarios, investors can prepare for different eventualities and mitigate risks. For instance, imagine a company considering expanding into a new market. This decision involves numerous uncertainties and potential challenges that need to be carefully evaluated. An event tree can illustrate the sequence of decisions and uncertainties involved, such as regulatory approvals, competitor reactions, and market demand. Each branch of the tree represents a different possible outcome, helping the company to visualize the various paths they might take. By assigning probabilities to each branch of the event tree, investors can calculate the overall probability of achieving their desired outcome and identify potential risks along the way. This quantitative approach provides a clearer picture of the potential success or failure of the venture. This visual representation simplifies complex decisions and helps investors communicate their thought process to stakeholders. It ensures that everyone involved has a clear understanding of the potential risks and rewards, facilitating better strategic planning and more effective decision-making. Section 7. Reducing risk through portfolio diversification. Diversification is a key principle in managing investment risk. By spreading investments across various asset classes, investors can protect themselves from significant losses. It involves spreading your investments across different asset classes, industries, and geographic regions. This strategy ensures that your portfolio is not overly dependent on the performance of a single asset or market. The idea is that losses in one investment can be offset by gains in another, reducing the overall volatility of your portfolio. This balance helps in maintaining a steady growth trajectory. Imagine you invest all your money in a single stock. This approach can be highly risky. If that company performs poorly, you stand to lose a significant portion of your investment. The impact can be devastating, especially if the stock market experiences a downturn. However, if you diversify your portfolio across different stocks, bonds, and real estate, you spread the risk. The negative impact of one poor-performing asset is cushioned by the performance of others. This cushioning effect is crucial in maintaining the stability of your investments. Diversification helps mitigate risk without necessarily sacrificing potential returns. It allows investors to achieve a balanced approach to growth and safety, making it a crucial strategy for long-term investors. By adopting diversification, investors can work towards their financial goals with greater confidence and reduced anxiety about market fluctuations. Section 8. The importance of understanding and managing risk. Failing to assess and manage risk can have serious consequences for investors. It can lead to poor investment decisions, unexpected losses, and missed opportunities. By understanding the different types of risk, using appropriate assessment tools, and implementing risk mitigation strategies like diversification, investors can make more informed decisions and increase their chances of achieving their financial goals. Remember that risk is an inherent part of investing. However, by acknowledging, analyzing, and managing risk effectively, investors can navigate the complexities of the market with greater confidence. Section 9. Conclusion: making informed investment decisions. In conclusion, mastering risk assessment is crucial for anyone looking to make informed investment decisions. By understanding the relationship between risk and return, utilizing various risk assessment models, and implementing appropriate risk management strategies, investors can approach the world of investing with greater confidence and increase their likelihood of success. Remember, successful investing is not about avoiding risk altogether, but rather about understanding, managing, and mitigating it effectively to achieve your financial goals.